The Bernie Madoff Ponzi scheme is one of the most infamous financial schemes in recent history. Bernie Madoff, the mastermind of the scheme, and the inner workings of the fraud that left thousands of investors devastated. The story of Madoff's rise and fall serves as a cautionary tale. But who exactly was he, and how did he get this all to work out? Born in Queens, New York in 1938, Madoff came from a humble background and worked his way up in the financial industry. He started his career as a lifeguard and later worked as a stockbroker, eventually starting his own firm, Bernard L. Madoff Investment Securities LLC. Madoff quickly established himself as a respected figure in the financial world, and his firm became one of the largest market makers on Wall Street. He was known for his steady returns and conservative investment strategy, which helped him attract a steady stream of wealthy investors. But behind the scenes, Madoff was running a massive Ponzi scheme, using money from new investors to pay off returns to earlier investors. He told his clients that their money was being invested in blue chip stocks and bonds, when in reality, he was using the money to pay off earlier investors, maintaining his extravagant lifestyle, and covering up his fraud. Madoff's Ponzi scheme was a complex web of deception that spanned decades. He promised his clients consistent, high returns on their investments, but when he realized that simply wasn't possible, he decided it'd be better to just run a Ponzi scheme. Whenever he'd get a new investor come on board, he'd use the money he'd get from them to pay off previous investors. This created the illusion of steady interest and helped attract more investors, allowing Madoff to keep the scheme going. Madoff also used a variety of tactics to cover up his fraud. For example, he would provide false account statements to investors, showing them their supposed investments and returns. He also used a technique called cherry picking, where he would selectively pay off some investors while keeping others in the dark. One of the reasons Madoff was able to pull off this scam for so long was that he was able to attract a wide range of investors, from wealthy individuals and charitable organizations to even banks and hedge funds. He also had a reputation, as we said before, as a respected figure in the financial world, which helped him maintain the trust of his clients. Nobody had thought that somebody like Madoff would be able to pull something like this off. The scale of Madoff's fraud was astounding. He had taken over $64 billion from investors, with many losing their entire life savings. The damage was so extensive that a court-appointed trustee was appointed to try and recover as much money as possible from Madoff's victims. But the story doesn't end there. Madoff's fraud had far-reaching consequences, damaging the trust in the financial system and leading to stricter regulations on the securities industry. In 2009, Madoff was eventually sentenced to 150 years in prison for his crimes. But for the thousands of victims, the damage had already been done. The Bernie Madoff scandal serves as a reminder of the importance of due diligence and the dangers of blindly trusting those who handle our finances, and the consequences of greed and the desire to maintain a certain image. Thank you for watching, and we will see you in the next one.